All right, we're getting into the good part here. Let's talk about fees, okay? And remember, these fees are specific to this particular Delaware Statutory Trust. It is possible that other Delaware trusts could have a different fee structure, but this company claims that they are the market leader, so I really doubt that anybody's going to have significantly different fees. Otherwise, if they were that much better, they'd be the market leader, okay? A lot of the fees that I'm talking about, actually all of them, they're all in here, okay, in this, what they call the private placement memorandum, which is basically, it's sort of like a prospectus for this, this vehicle. Like I said, very big, over 130 pages of fine print. And a lot of what I'm going to say, I'm basically quoting from their fine print, okay? Let's start with some of the basics. It says, the costs associated with a Section 1031 exchange may impact the returns and may outweigh the tax benefits of the transaction. Right, okay, so you may end up paying more fees than what you're going to save in your capital gains taxes. Okay, here we go again. Each prospective investor is responsible for all costs associated with his, her, or its independent accountant, tax advisor, financial advisor, and attorney. This is part of the assumption that they make for what they call accredited investors, and we'll talk about this later when we get into some of the other fine print about these Delaware trusts being exempt from certain SEC regulations and what it means to be an accredited investor. But just for right now, what that means is that the investors are responsible for doing their own due diligence, which means hiring accountants, hiring lawyers. How much would you like to pay an attorney to go through this? How much are they going to charge you? And that's all coming out of your pocket before you see any returns. Now, here's the good part. This is from what they call the estimated use of proceeds. And this breaks down a lot of the front-end fees. So I'm going to go through that, and let's see how this works if I write down some of these calculations right here, and we'll see if we can make that work on camera. All right, here we go with the front-end fees here. They've got these under selling commissions and expenses. Commissions and expenses. We've got selling commissions. This would be to the broker-dealer who's actually trying to sell you this product. That is 5%. And we've got dealer fee is 1.25%. Okay, we've got a placement agent fee. I'm not going to try and explain what all these things are because I don't think it's that relevant. 1.65%. O&O expenses. 0.75%. Third party due diligence. Is 0.07%. And add those all up, comes to 8.72%. Okay. And then they have another section called costs of acquisition. Okay. And that is 3.78%. So your total front-end fees. So fees come out to 12.50%. This is not counting all your attorney's fees and accountant's cost and all that good stuff. Okay, 12.5%. And so this is what you're going to pay up front, and then you're also going to have monthly property management fees. Management fees of 4%. And there's a little fine print that goes along with those, and we'll talk about those in a few minutes. And we have back-end commission when they sell the property. And it says, what it says is, it says half of reasonable real estate or brokerage commission, or 1.5% of the sales price of the property. So I'm going to guess that they're probably not all that different. So we will just call it 1.5%. Okay. All right, so now we're going to take a hypothetical, okay? Let's take a hypothetical and say that let's say we sold a property, and let's say we got $1 million out of that property, just to keep a nice round number, okay? So $1 million times our front end, 12.5%. There's our front end load, okay? Equals $125,000 that we're paying up front, okay? And let's keep in mind, that's $125,000 that is not being used to buy the property, okay? Now here, I was thinking about something else too. Okay. So this goes with our capital gains tax, okay? Because when you pay capital gains, we're paying capital gains on the appreciation of the property since we acquired it. Now that could be whether it's since you bought it or since you inherited it, because when you inherited it, you should get a step up in basis at the time of the inheritance. Okay, so I want to look at this again. Okay, we're going to take our same hypothetical $1 million. Okay, so let's say we sold that property for $1 million. Total property, $1 million. Okay, and if I back that out, and let's say from the time that we acquired it until now, because I'm guessing, maybe let's say we acquired it, and these would change for everybody, but in our case, maybe this is a good guess that we'll say, let's say it gained 10% over the time that we acquired it. That means that our original basis that we got it at was $909,090.91. That was what we acquired it at, okay? So our capital gains would be on the difference between those. And the difference between $1 million and 909,000, yada, 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 is $90,909.09. That's capital gains. Okay? And we're going to be conservative here, and we're going to estimate 20% capital gains tax. 20%. So it could be a little more. Most likely would be less. It could be 15 to 20, depending on your total income and what your other income is. So it could be 15, it could be 20, it could be 20 plus I think it's about 3% Medicare tax. So, but we're gonna go with the 20 right now. So we'll say estimated 20% capital gains tax is $90,909 times 20% is about $18,181.82. Okay? Does that work? So this is how much we would have to pay in capital gains tax. But remember, we had our Delaware Statutory Trust, and if we were going to take that $1 million and put it into a Delaware Statutory Trust, we would defer this as long as we keep on going into another Delaware Statutory Trust, or take it out and roll it into some other property, income property, something like that, that would give us a like-kind exchange. But the cost, remember, on the previous page, 12.5% would be $125,000 front end load, not counting attorney's fees, CPA fees, all that other stuff. Okay, so pay capital gains tax now of $18,181. We'll pay $125,000 for the front end load of the Delaware Statutory Trust. And then on top of that is we have to consider that each time the Delaware Trusts lasts usually in the range of 3 to 10 years. And during that 3 to 10 years, and we'll talk about this more later, it is almost 100% illiquid. You cannot get out of it. But and maybe an average of about 6 to 7 years for each Delaware Trust. Okay, so it's almost illiquid. You can't take your money out if you want it. The only thing you get is whatever income you get from the monthly rents after all those fees. But then every 3 to 10 years, you're going to have to pay this again, plus the back end fees too. Remember, another about 1.5%. So that's a lot of fees that's taking out of any potential returns that you have. All right, let's continue. We've got another fee that they call an additional rent breakpoint. And what it says is the difference between the base rent and the additional rent breakpoint for any property for a given month, if any, after taking into account any expenses for such property, will inure to the benefit of the applicable master tenant. That's them. This will result in additional income to the master tenants, which amounts will not be available for distribution to the parent trust or the investors. Again, if the rents go beyond this base rent, then they're taking a big chunk of what comes after that, and this would also limit potential upside to investors. So there's going to be a lot of instances here where it seems like there may be sort of somewhat low consistent return, but the opportunity to increase those returns is very, very limited because of the way this thing is structured. Now we have another one. Okay, the property manager, this is the property management fees. Property manager is entitled a monthly property management fee in an amount equal to 4% of the gross income generated by the property for the month in which the payment is made. Okay, we talked about that, 4% property management fee. A little bit more fine print here. The master tenant is responsible for reimbursing the property manager for all expenses paid or incurred by the property manager, so the master tenant. Okay, so the property manager is going to collect all these other fees or reimbursements on top of their 4%, including all expenses and the costs of salaries and benefits of persons employed by the property manager or its affiliates. So the property management fee is not 4%. It's 4% plus all their expenses. So, and something to keep in mind here is that the property manager and all these people that are doing all these different things related to these properties, they are all related parties. They're all under one parent company. So no arm's length transactions, and we'll get into that a little bit more later too. Let's move on. The trustees are entitled to receive significant fees and other compensation and payments regardless of whether the parent trust or operating trusts are profitable. Those fees will be paid prior to any distributions to the investors. So maybe there's other fees that I've missed here, but they're just saying, hey, we've got other stuff too. Here we go again. The sponsor increased the aggregate purchase price of the interests above the anticipated aggregate acquisition cost with respect to the properties to cover selling commissions, loan fees, transfer taxes, legal and accounting expenses, and other costs associated with the acquisition and the offering. These additional costs will cause the cost of your investment in an interest to exceed the pro rata share of the market value of the properties. In order to make a profit on the sale of the properties or any interest, the investors will need to receive sufficient proceeds to recover the added acquisition costs included in the original purchase price, as well as the costs associated with their own attorneys and tax advisors, and any costs related to the disposition of the properties or interest. So, what does that mean? It means that the amount of money that they're collecting for this Delaware Statutory Trust is a lot more than the value of the properties. And we know that because you've got this 12.5% front-end fees and a 1.5% back-end fees. Somebody has to pay for that. So if you've got your hypothetical $1 million investment, and they just charge you $125,000 in fees, then only $875,000 of your $1 million is going to actually be invested in the properties. So those properties will have to have a return high enough to recoup that 12.5% and then give you a return on top of that in order for you to make profit. Let's see. Any proceeds realized from the sale of the properties will be distributed to the investors in accordance with their respective interests, but only after payment of any loan then outstanding on the properties and any other loans, expenses of the transaction, including a broker's fee and back-end sales commissions to the asset managers. And this is what we talked about before, the back-end commission. A back-end sales commission in an amount not to exceed the lesser of 1/2 of the real estate or brokerage commission that is reasonable, or 1.5% of the gross sales price of the property. So I think right now we'll kind of cut it there as far as the fees are concerned, but just to make it clear that that's a lot of money in fees that they're collecting out of your original investment, and it makes it very, very difficult to make a significant profit on top of that. So perhaps in the future we'll talk about what some of our other alternatives for investment might be. But for now, that's sort of the basics on the fees on this particular trust. And in a future video, we will talk about some of the other issues. Okay.